Everybody, this is lecture for topic 10, ACT3112. This is the last topic in this course this semester. Okay, the title of this topic is Introduction to Cost and Management Accounting. So from topic 1 to topic 9, you have learned about financial accounting. Financial accounting is the accounting that you use when you want to make a record of business transaction and you want to calculate profit or loss for your business. When you want to do financial accounting, you have to follow accounting cycle from step 1 to step 8. So the step 1 is you analyze the business transaction, and the last step in the accounting cycle is you do closing entries. The output of financial accounting is the financial statement. Financial statement contains income statement, balance sheet, statement of equity, statement of cash flow, and notes to the account. So you have done that. So in this topic, in the last topic, you will be introduced to two more branches of accounting, which is the cost accounting and management accounting. Okay, let's see what is the thing about related to this topic. So let's see the definition first. What is cost accounting? So here it says that in this slide, the first point, cost accounting is a systematic set of procedures for recording and reporting measurements of the cost of manufacturing goods and performing services in the aggregate and in detail. So basically, cost accounting is the accounting that you use when you want to calculate costs of product produced by your business or cost of services produced by your business. That's the simple definition. And the second point here is management accounting. So what is the management accounting? See here, the second point there. Management accounting is a system that produces reports about business operations that help managers make short-term and long-term decisions. So management accounting is the accounting that you can use is the accounting that you can use, and the output of the management accounting is useful for managers. You do management accounting to help managers to make business decisions. In a business, the person who is responsible to manage the business, to manage the operation of the business, is the manager. A manager has to make many business decisions every day. The manager has to decide how many products to produce, how many workers to hire, how many branches to open, whether to purchase machine or to hire more workers, etc. There are many decisions have to be made by a manager every day. So management accounting is the accounting that you can use to produce information that can help the manager to make business decisions. I hope I have told you before that there are several branches of accounting. The main branches of accounting are two: financial accounting and management accounting. Other than that, there are also other branches of accounting. Like this one, cost accounting is another branch of accounting. Another one is merger and acquisition accounting, and then auditing, internal auditing, forensic accounting. I think most of them. So here in this topic, you will learn about the introduction to cost accounting and management accounting. So cost accounting and management accounting overlap. Sometimes the calculation of cost accounting is also categorized, can be categorized as a calculation for management accounting. So when you learn about management accounting, if in the future you have to take a management accounting course, you will see that when you learn about management accounting, you also will learn about how to calculate costs. Okay, so these two branch of accounting are overlap. Okay, now we focus on one thing. So most of the time, if you learn about management accounting or cost accounting, you will focus on manufacturing businesses, because manufacturing businesses produce product. So that's why the management accounting and cost accounting are relevant for manufacturing businesses because they produce product. And cost accounting and management accounting most of the time is related to cost of product, decision about product, etc. Okay, now to understand both the cost accounting and management accounting, firstly you have to know what is the definition of cost. See the third point here in this slide. Cost denotes the amount of money that a company spends on the creation or production of goods or services. So the simple way to define it is like this. Costs are the amount that a business pay when the business produces goods or product, or when the business providing services. So in this topic, you will learn about these three things. First, the type of cost according to the behavior of the cost. And then second, you will learn about manufacturing cost. The type of cost, and it is focusing on the manufacturing cost. Cost to manufacture a product. The third point, or the third thing that you will learn in this topic is the way to prepare income statement and balance sheet for manufacturing business. So remember, there are three main types of business according to the sector: service business, merchandising business, and manufacturing business. When you learn topic 1 to topic 5, you have learned about how to prepare income statement and balance sheet for a merchandising business. But here in this topic 10, you will learn about how to prepare income statement and balance sheet for a manufacturing business. The format is same, everything is same. I think the only difference is manufacturing business has three types of inventories. That is the only difference. So you have to show the three types of inventories in the balance sheet. And also when you prepare the income statement, you have to calculate one thing: cost of goods manufactured. So revenue minus cost of goods manufactured, you will get cost of goods sold. You will get gross profit, and then after that you minus expenses, and then you will get the net profit. You will see that in the later slide. Okay, now you see cost category or types according to the behavior. Behavior is the way it go up and down, the way the cost increase or decrease. So if we look at the behavior, whether the cost is increased or decreased, then we can see the several categories of cost or type of cost. Okay, see here, cost behavior analysis. Point 1 examines how costs behave when level of business activity change. So costs will change when the quantity of production, or when the production activity changes. The logic is the more quantity of production, the higher the cost. The lower the quantity of production, the lower the cost. The more the business do production activities, the more the cost. The less the production activities happen in a business, the less the cost. So when there is a change in the production, in the quantity of production or in the process of production, some costs will change, some costs will not change or stay the same. Okay, point number 3. Knowledge about cost behavior help in planning and choosing between alternatives. So you will see that in the later slide. If you want to categorize cost according to its behavior, you have to start with identifying the key activities and their relationship with the cost, the key production activities. This is not difficult. This is actually very easy. Okay, so when you categorize cost according to its behavior, one of the category is called variable cost. Imagine you are in a factory, and the factory produces something. Let's say you have a factory that produces frozen food. Frozen food. Let's say you what kind of frozen food to make it easy for you? I cannot say. Okay, let's say imagine you have a factory that produces frozen food. Okay, so when you produce that, you have a factory like that. Imagine every day your factory has workers to do the production process. You have machines. You have direct material to produce the frozen food. You use maybe flour, sugar, butter, color. So that are called direct material costs. And then your workers are called labor costs, direct labor costs. The workers who involved in the production process are called labor. Their salary is called labor cost. You have to pay them. And then in your factory you have machines. To maintain the machines, you will have maintenance workers, and then you have to pay electricity for your factory to run the machine, etc. So some of the costs that you have to pay during the production can be categorized as variable costs. Variable costs are costs that will change when the quantity of production is changing. The typical example of variable cost is direct material cost and direct labor cost. Imagine if you produce frozen food. When you produce 1 unit frozen food, you have to pay for material costs like sugar, flour, coloring, butter, etc. And also at the same time you have to pay for the labor. So let's say direct material cost is $3. Direct labor cost for one of your frozen food is $1. So for one product, you pay $3 of material and $1 of labor cost. So 2 products, it becomes $6 for material and $2 for labor. 10 products, it will become $30 for material and $10 for labor. So this direct material cost and direct labor cost will increase when the quantity of production increasing. When the quantity of production decrease, the variable cost also decrease. So this kind of cost is called variable cost. See the second point, they are identified on a per unit basis. So the variable cost will increase according to the unit of the production. You produce 1 unit, the cost is like this. 2 units, the cost will become double. 10 units, the cost increase 10 times. So that is the variable cost. And then point number 3, variable cost stay the same per unit as activity level changes. So unit variable cost is same. One product, the cost like if we use the example that I have given, 1 unit product, the cost is $4. 2 units product, the total variable cost will become $8. But the cost per unit is same, $4. So total variable cost changes in the proportion to change in the activity level or production unit. Okay, if we plot the graph for variable cost, the graph will look like this. CA, the first graph there, the graph A is the graph for total variable cost. If you plot the graph for total variable cost, the line is the line that you can see in the graph A. So the x-axis is the quantity, y-axis is the dollar. So see there, if you produce 0 product, the variable cost is 0. If you produce 1 product, then the cost will increase. Using my example, the cost is $4 frozen food cost. But here the cost is 1 unit product $2. 1 unit product $10. 2 unit product, the cost become $20. 4 units product, the cost become $40. So 6 unit products, the cost become $60. So that is the cost for, the graph for total variable cost. B is the graph for unit variable cost. The unit variable cost is same no matter how many units the business produces the product. See there the graph, the unit variable cost, whether the business produces 2 units or 6 units or 10 units, cost of variable cost per unit is still same. 1 unit, the variable cost is 10. At any level, the cost of the variable cost is same. So that is the nature or the graph for unit variable cost. Okay, another type of cost or category of cost, according to the behavior, is called fixed cost. Fixed costs are costs that do not change with the decrease or increase in the quantity of production or in the level of business activity. This cost, the example of this cost, I think the clearest and simple example for this cost is the rental. Let's say you have a factory that produces frozen food, and then the factory is a rented factory. You rented the factory. You rent the factory, every month you have to pay $10,000. So that is an example of fixed cost. No matter how many units of frozen food you produce, every month you have to pay rental $10,000. It is fixed. Okay. Another example of fixed cost is supervisor salary. If you have a factory, you have many workers. You have to hire a supervisor or several supervisors. The responsibility of a supervisor is to monitor the workers, to make sure them to come to the work every day, to make sure they do works in the correct place, and they do works in the correct way, in the right way, to monitor everything related to the workers. So the supervisor salary is a fixed cost because no matter how many unit the business produces product, the business has to pay the same amount of salary to the supervisor every month. But the factory worker, the assembly workers, the more they do works, the more the business has to pay. But supervisor, same amount every month, because the supervisor just monitor the workers. He or she does not involve in the assembly of a product. Insurance is also an example of fixed cost. If you have a factory, maybe you have to pay property insurance or something, building insurance or something, and the amount is fixed. Every year, this amount you have to pay. No matter how many unit product you produce, the insurance expense is set or fixed. The insurance expense does not increase or decrease according to the quantity of production or activity of production. Okay, see this that point there. So fixed cost, if you have to calculate fixed cost per unit, then the way to do it is you just find the data for total fixed cost in one accounting period, for example 1 month or 1 year, and then divide it with the unit of activity level or quantity of production, so you will get the number for fixed cost per unit. If you have to calculate total fixed cost, then you just have to add all the fixed cost items, and you will get the total fixed cost. For example, you have a business that produces frozen food. So you want to know what is the total fixed cost. So the total fixed cost equal to maybe rental expense, and then insurance, property insurance expense. Another one is depreciation for the factory equipment expense, supervisor salary expense. So you just add all these fixed expenses, you will get the total fixed cost or fixed expenses. Okay, there's something unique about fixed cost is fixed cost, the total fixed cost will not change no matter how many unit of product produces by a business, but unit fixed cost will become lower when a business produces more product. So we will see that in the graph here. You see here, A is the graph for total fixed cost. So if you have a business, let's say in this example, total fixed cost every month or every year is $10,000. So no matter how many production unit, 1, 2, 3 or 10,000, 2,000, etc., the total fixed cost is same. It will not change. That is what we call as total fixed cost. But if we calculate unit fixed cost, then the calculation is total fixed cost divided by the quantity of production or unit or level of production. So if we do that, if we calculate unit fixed cost, then you will get a line like the B graph. The more product you produce, the less the unit fixed cost, because total fixed cost you divide by the number of the quantity of production. The more you produce, the lower the unit fixed cost. Let's say you have a business, and then the total fixed cost for your business every month is $10,000. So if the quantity of production, your quantity of production is 100 unit, so the unit fixed cost is $10,000 divided by 100. So the unit fixed cost for your business is $100 per unit. But if you produces 1,000 unit product per month, so how much is the unit fixed cost? The unit fixed cost is equal to $10,000, which is the total fixed cost, divided by 1,000 unit. So 10,000 unit divided by 1,000 equal to 10. Okay, $10. The unit fixed cost is $10 at the 1,000 unit of production. So the bigger the quantity of production, the smaller the unit fixed cost. So okay, there are several costs that can be categorized as mixed cost. A mixed cost is an item that has both the characteristic of fixed cost and variable cost. The simple example is like the telephone line that we have at home. I don't have telephone line at home now, but many years ago, when I have telephone line at home, the cost is like this. I have to pay fixed amount, $20 every month. That is fixed. But whenever I call somebody using the telephone at home, I have to pay like 10 cents per minute. That is the variable component of the cost. The fixed component of the cost is the $20 that I have to pay every month. That is fixed. The variable is 10 cents per minute. I think now electricity at home, maybe something like that also. Electricity at home, I think I have to pay like $20 or $10 fixed every month. And then after that, whenever I use the electricity, I have to pay I do not know, several ringgit for every 1,000 kilowatt or something. I don't know, but there is a fixed component and variable component of the electricity cost. So that kind of cost in accounting, we call them mixed cost. They have both the component of fixed cost and variable cost. Mixed costs are often separated into fixed and variable components at the end of period. So at the end of accounting period. So if you have to calculate total cost at the end of accounting period, for this mixed cost, you have to show the variable component and fixed component separately. Okay, mixed cost, if you plot a graph for mixed cost, then you will get a graph like this. The graph like the one that you can see in this slide. In this example, the fixed component is $50. So for this business, maybe every month the business has to pay fixed cost 50. And the next thing is, I think, what else? Maybe for every 1 kilometer, the business has to pay $1 cost for this item. So for this item, the fixed component is $50 maybe per month, and maybe the item is a motor vehicle or something. So every kilometer used, the cost is $1. So, or maybe 50 cents. I'm not sure. So you can see here, when you plot the graph for the mixed cost, the graph will show a fixed component and also the variable component. Okay, so why it is important to know why, if you have let's say you have a business, you have a factory, why it is important for you to identify which costs are fixed costs and which costs are variable costs. So there are several reasons for that. First, effect on the profitability of reduction in sales price. So when you know the what is the unit variable cost and total fixed cost for your business, you can calculate the effect of the decrement or increment in sales in the sales price to your profit. The basic formula that you can use to see the effect of changes in revenue or sales effect on the profit is like this. The basic formula is revenue minus fixed cost minus variable cost equal to profit. Revenue minus fixed cost minus variable cost equal to profit. So when there is a changes in revenue, you can see the effect on profit, whether the profit will increase or decrease. And then the second importance of identifying cost, whether it is fixed or variable, is you can see the effect of on activity level when expenses increase per unit to keep the current profitability. And number 3, minimum level of sales to cover costs. And then number 4, cost of maintaining level of production for different manufacturing methods. So there are many. It is very useful. If you have a business, if you can identify the cost of your business, whether it is a fixed cost or variable cost, you can do many things. You can calculate expected profit. You can calculate how to manipulate the cost so that you achieve certain amount of profit, and how to manipulate the quantity of production to achieve certain level of profit, etc. So that is the main thing. Using the basic formula. The basic formula is total revenue minus total fixed cost minus total variable cost equals to profit. You just manipulate the number. You change in the revenue, you can see what is the effect on the profit. You change the fixed cost, you also can see the effect on the profit. You change in the variable cost, you also can see the effect on the profitability of the business. Okay, this is the second category of cost that you have to know. It is called manufacturing cost. So remember this. Manufacturing costs are costs that that a business has to pay when the business produces a product. Imagine, I ask you to imagine that you have a factory that produces frozen food. Imagine that you are in the factory. When you are in the factory, you will see, firstly, you will see material. To produce the frozen food, you need materials, raw materials like flour, sugar, butter, coloring, yeast, what else? Water, and many more. Baking powder or something. So these are material. After that, if you want to produce the product, you need workers. You need workers to process the material. And then also maybe you need machines or equipments. You need the building and several more things, so that you can your factory can produce the frozen food. Okay, so that when the business pay for the direct material, when the business purchase the sugar, butter, etc. from the supplier, the cost to purchase that material from the supplier is called direct material cost. And then when you have a factory and then you have several workers in the factory to process the product to assemble the product, you have to pay them salary. That salary that you pay to the workers is called direct labor cost. And then and then if you have factory, you also have to pay other costs related to the production. For example, salary for the supervisors. Like I said earlier, if you have a factory, you have many workers, you have to appoint supervisors to monitor the workers, to help the workers with the production process. So the salary of the supervisor is a cost, is a manufacturing cost. And then you have to have maybe a maintenance workers. The maintenance workers does not involved in the production process, but he maintain the machines and the equipments that you have in a factory. If you have a factory, you will have many machines. Somebody need to maintain that machines and equipment. You need to clean that machine and equipments, need to do regular service or etc. And then you will have, if you have a factory, you have to calculate the depreciation, because the factory is a building, so depreciation is also a production cost if it is a depreciation for the factory building. Okay, so there are many costs. I hope you can imagine. So in accounting, when we say manufacturing cost, it is the cost to produce a product. So in accounting, manufacturing cost equal to direct material cost plus direct labor cost plus manufacturing overhead. What is the direct material cost? Direct material cost. So first we have to know what is the direct material. Direct material, material that you can see in the finished product. So let's say your product is frozen food. When you see the frozen food, you can see flour, sugar, coloring, maybe butter. So these are called direct material. The amount that the business pay to purchase this material from supplier is called direct material cost. Okay, so that is the first manufacturing cost, direct material. In most factories, the biggest cost is the direct material cost in many factories. The second manufacturing cost is called direct labor cost. So you have to know what is direct labor first. Direct labor are workers who involved in the assembly of a product or in the process to produce the product. The common the common term that we use is, we call them factory workers. They involved in the assembly of the product. So if the business is producing frozen food, the workers who involved in the mixing the ingredients and in the packaging the product are called direct labor. The salary that the business pay to this direct labor is called direct labor cost. It is the second manufacturing cost. And then the third manufacturing cost is the manufacturing overhead cost. See the third point in this slide, manufacturing overhead cost. Manufacturing overhead costs are other costs that the business has to pay related to the production process. So other costs related to the factory that the business has. For example, like I said earlier, factory rental is an example of manufacturing overhead cost. Supervisor salary is also a manufacturing overhead cost. Depreciation for factory equipments is also the overhead cost. Salary of the maintenance workers. Remember, I told you, if you have a factory, there are many machine and equipment. You have to have maintenance workers to clean this machine and equipment, to do regular service. So the salary that you pay to these maintenance workers is a manufacturing overhead cost. They are not direct labor because they do not involve in the production process. They just maintain the machine. If you have janitors in your factory, the salary to the janitors is also one of the manufacturing overhead cost. If you have a security guard to in your factory, he keep the factory safe. The salary that you pay to the security guard is one of the manufacturing overhead costs. Okay, so if you are given a list of costs, and then the question asks you to calculate manufacturing cost. So the answer is manufacturing cost equal to direct material cost plus direct labor cost plus manufacturing overhead cost. So you find how much is the direct material cost, how much is the direct labor cost, and you find items related to manufacturing overhead. And then you can calculate the total manufacturing cost. If you have a manufacturing business, you have a factory, for example, you have a frozen food factory or frozen food business, the typical thing that happen is you have a building. In that building, there is a section for management office where the managers are working and the admin workers are working, and also you will have a section for factory. Manufacturing costs are costs related to the factory. Okay, the cost related to the management office, like the salary for the CEO, the salary for the salaries for the executives, marketing manager, purchasing officer, salesperson, etc. You have to pay them. You have to pay salaries to them, but they are non-manufacturing costs. They are not manufacturing costs. They do not involve in the manufacturing process. So their salaries, etc. are non-manufacturing costs. Manufacturing costs are only costs that are related to the factory where the production process happen. So if I give you a list of costs, you have to know how to identify which one is manufacturing cost, which one is non-manufacturing cost, which one is overhead cost, which one is direct material cost, which one is direct labor cost, etc. So all costs, okay, this is like the summary that I have explained. If you have a business that produces frozen food, then the total cost for your business equal to manufacturing cost or product cost plus non-manufacturing cost or period cost. Okay, so that is the total cost. So what are the manufacturing costs or product costs? Like I said earlier, in accounting, the cost to manufacture a product are three. First, direct material cost. Second, direct labor cost. Third, manufacturing overhead cost. So total manufacturing cost equal to direct material cost plus direct labor cost plus manufacturing overhead cost. And also I have told you, if you have a frozen food business, typically you will have a building, and that building has a section or space for management office and another section or space for the factory. So all the costs related to the factory are manufacturing costs, but all the costs that are related to the management office are called non-manufacturing costs, or also can be called period costs. Because why these costs are called period costs? Because most of the time you have to pay them periodically, every month, every year, every 6 months maybe. So that for salary for the manager, you have to pay them every month. The depreciation of office personal computer, you have to calculate the depreciation every year. So that's why most of the time non-manufacturing costs are also called period costs, because you have to pay them periodically. But manufacturing costs are also called as product costs. Why manufacturing costs are called product costs, are also called product costs? Because the manufacturing costs will increase whenever the business produce something. So that's why they are called production costs. Okay, period costs can be divided into two categories: selling expenses and admin expenses. So imagine you have a frozen food business, and then now you are sitting in the management office. So you can see around you there are marketing managers, salesperson, human resource manager, what else? General clerk, IT department. In the IT department, you have IT manager, IT technician. Okay, so there are many people in the management office. Okay, and then when there are many people there are equipment there, personal computer, printers, etc. There are many costs related there. There are many non-manufacturing costs related to the management office. So all these costs that a business has to pay in the management office building can be categorized into two types: selling expenses and admin expenses. Selling expenses are expenses related to activities to get to market the product to customer and to get orders from customer. So the salary for the salesperson, for the for the marketing manager, what else? Okay, these two people, their salary has to be categorized as selling expenses. Costs other than selling costs are categorized as admin costs or admin expenses. Costs like depreciation of computer in the office, in the management office. Okay, it is not related to sales, so it can be categorized as admin expenses and admin expense. Cost of the human resource manager salary, is it a selling cost or admin cost? Human resource manager does not involve in getting orders from customer or marketing, so his salary is a non-manufacturing cost and it can be categorized as admin cost. If in the business there is an accountant, the accountant do the calculation for the cost and profit, calculate profit and or loss, etc. So what do you think? An accountant, is the salary of the accountant has to be categorized as selling expense or admin expense? The salary is admin expense because the accountant does not involve in the activity to sell or to get orders from customer. Okay, so if I give you a list of costs, you have to know which one is non-manufacturing cost, which one is manufacturing cost, which one is direct material cost, which one is direct labor cost, which one is overhead cost, which one is admin cost, which one is admin cost, which one is selling cost or selling expense. Okay, another thing about the manufacturing overhead cost, one more thing about the manufacturing cost is like this. You know that manufacturing cost equal to direct material plus direct labor plus overhead cost. Okay, that you know that already. But there is another category related to manufacturing cost. Direct material cost plus direct labor cost is known as prime cost. Or in another way, if somebody asks you to calculate prime cost, then the answer is prime cost equal to direct material cost plus direct labor cost. See in the yellow box there, prime cost equal to direct material cost plus direct labor cost. Why direct material cost plus direct labor cost are called prime cost? Because most of the time, the biggest cost that a business has to pay in the production process is the cost of direct material and the cost of labor. That is the most of the time. Okay. Overhead, manufacturing overhead. In many businesses, manufacturing overhead is a small portion of the total manufacturing cost. So when somebody asks you to calculate prime cost, please remember prime cost equal to direct material cost plus direct labor cost. Another thing is direct labor cost plus overhead, manufacturing overhead, equal to conversion cost. Direct labor cost plus manufacturing overhead cost equal to conversion cost. Why we call direct labor cost and manufacturing overhead cost as conversion cost? Because in a factory, you need the labor and overhead to convert the raw material to become a finished product. That's why direct labor cost plus manufacturing overhead cost are called conversion cost. Cost to convert direct material to become a finished product. So these are the things that I have explained: product cost, conversion cost, and period cost. Okay, I think I will stop here. Or I have to continue because like we have only 1 or 2 slides left. Okay, I will continue. If you cannot understand, then you have time to watch this video again and again. So I hope you can follow. Okay, this is like the last section in this topic. In this section, you will learn about how to prepare income statement and balance sheet for a manufacturing business. So this is an example of the format for income statement for manufacturing business. Okay, so if somebody asks you to prepare an income statement for a manufacturing business, then the format is like this. Income statement for a manufacturing business, the first thing that you have to show is the revenue or sales. See there, the first item in this income statement is sales. The year is supposed to be 2021. Okay, sales equal to how much? Okay, so most of the time when you have to prepare income statement, you have to use 2 columns. See here, sales. You write the amount of sales. You use 2 columns to make it easy for the reader to see the different item. So sales and then minus cost of goods sold. Okay. When you want to calculate the cost of goods sold, the first item that you have to show is the beginning finished goods inventory. And then you have to add cost of goods manufactured. Beginning finished goods inventory is easy to find. If you have a business, you can if there is a question asks you to prepare income statement for a manufacturing business, finished goods inventory beginning is easy to find because the question will show the data. Okay, this is the beginning in finished goods inventory, and then this is the ending finished goods inventory. Remember, a manufacturing business has 3 types of inventories: direct material inventory, work in process inventory, and finished goods inventory. So when you prepare the income statement, when you want to calculate the cost of goods sold, see in this calculation, the first thing that you have to show in the calculation of cost of goods sold is the finished goods inventory, beginning finished goods inventory. And then after that, you have to add cost of goods manufactured. Okay, to find the cost of goods manufactured, you have to prepare a schedule. It is called the schedule of cost of goods manufactured. And then after that, you minus ending finished goods inventory. So you will get the cost of goods sold. So revenue, see here in the third column, revenue minus the cost of goods sold, you will get gross profit. After you got the gross profit, you have to minus the non-manufacturing cost. The first one is selling cost, and the second one is the admin cost. So the gross profit minus the selling cost and admin cost, you will get the net profit. Okay, back to the calculation of cost of goods sold. I told you the second item in the calculation, cost of goods manufactured, to get the number or the amount for the cost of goods manufactured, you have to prepare a schedule or a statement. Okay, this is the statement. Okay, this is the statement that you can use to calculate the cost of goods manufactured. When you want to calculate the cost of goods manufactured, the basic formula is direct material cost plus direct labor cost plus overhead cost. See here, the first thing that you have to do is to calculate the direct material cost. So to calculate the direct material cost during an accounting period, the calculation is beginning raw material plus purchasing raw material, and then minus ending raw material. So you will get the direct material used in one accounting period. And then you have to show the direct labor cost. So direct labor cost is the salary of the assembly workers. So direct material cost plus direct labor cost equal to prime cost. Remember, see the last item in the slide, prime cost. So prime cost equal to the direct material cost plus the direct labor cost. Okay. And then you have to show all the overhead costs related to the business. The overhead costs can be indirect labor, factory repairs, depreciation of the factory machine or equipment. So there are many more, I think. So, and then you calculate the total overhead costs. When you add the direct material cost from the previous slide, prime cost plus the total overhead cost, you will get the total manufacturing cost. And then do not forget to add work in process inventory beginning or opening and minus work in process inventory ending. So the final figure or number is the one that we call cost of goods manufactured. I have a video that I have made explaining about how to prepare this cost of goods manufactured schedule and also the income statement for a manufacturing business. I hope I will share with you the video after this. That's all for today. This is the end of the syllabus. Okay, this is the last one. I think this is the last thing in the syllabus. So this is a sample question. The question can give you a list of all costs, and then you have to identify which one is direct material cost, which one is direct labor cost, which one is manufacturing overhead cost, which one is prime cost, which one is conversion cost, which one is the period cost. So if you are given this kind of question, one cost maybe is related to more than one category. For example, raw material. Okay, raw material, see here the second item in this table, raw material is a direct material, and also it is a prime cost. Okay, so property tax is a manufacturing overhead cost, and it is also a conversion cost. Advertising, so advertising, see the third item from the last item, from the bottom of this table. Advertising, it is not a direct material cost, not direct labor cost, not manufacturing overhead cost, not prime cost, not conversion cost, but is a period cost. Okay, so that's all for this topic. Do not forget to write your name and metric number in the comment section of the video. I will record that as the lecture attendance. Thank you very much.